So today we are going to take the model that you did for your homework 4 and pick up there and finish up the valuation model using Coca-Cola as an example. So basically, I want to introduce you to homework 5, which will be due Wednesday, as in 2 days from today, at 10 a.m., is to basically complete everything we do in class today. So if you don't finish by the end of class and you're following along, then you have until Wednesday morning at 10 a.m. I am recording the class, so you're welcome to look at the video if you have any trouble. But if you finish what we do in class, then you have finished the homework assignment for Wednesday. And again, that's what you're going to upload as homework 5. This is an individual assignment. It's not a group assignment. Okay, so you can't use somebody else's file. You have to create it all individually. On Wednesday, we're going to do our next graded Bloomberg lab. So just to give you a sense of this, today, part of finishing the model will be finishing what we're going to call an as-is valuation of Coca-Cola. At Wednesday, at the beginning of class, I will give you a different company. All right? Let's just say it's Pepsi. It won't be Pepsi. But if it were Pepsi, then you're going to have to get all of the data out of Bloomberg, put it in this model, and then value Pepsi. Okay? So that will be Wednesday's class assignment. Okay? Which again, you will do individually. You will not do this as a group. Part of the reason why I want you to do this individually is because there's a lot going on with this model that we're building. If somebody else builds it for you, you're going to be clueless. And this is the model that you're going to use for your group projects. This is the model we're going to be doing a lot of work on throughout the rest of the next several weeks. So you're going to be heavily invested in using this model. So it's kind of in your best interest to do it yourself. Otherwise, you're going to get very lost very quickly as to what's going on here in this class. Right? So with that in mind, as I said, in just a minute, we're going to pick up where we left off with the model that you turned in for your homework for today. Okay? And then we're going to keep building on it. And as I said, finishing up the valuation of Coke. One other thing about the group projects, I talked to the CFO of Novellus last week. They're getting to me a list of the companies that they want us to evaluate for the aluminum industry. He's going to China tomorrow, so if he doesn't get them to me today, then I may not have them for us to pick companies on Wednesday. So just to let you know that we're either going to pick companies on Wednesday or Monday of next week for your group projects. All right, but very quickly, we're going to be starting the group projects. This spreadsheet that we're finishing today is basically one of the core parts of your group valuation project. So you will be using this for your group project as well. Okay? All right, so what I want to do, as I said, is pick up where we left off. And where we left off last week is we had created a forecast for Coca-Cola's financial statements, which gave us a forecast excuse me, for their cash flows and their economic statements. So starting from there, we want to start to do the valuation. Now, on the video from last Monday, the video talked about Home Depot as an example, and one of the slides in the video, which I've posted as lecture note 6, by the way, onto Canvas, looked just like this. And this was how Home Depot was valued by McKinsey. This, believe it or not, is their actual process for doing the summary valuation. And this is what we're going to put, as I mentioned in the video, into our valuation model. So the first thing we want to do is go back to our valuation model in Excel, and we want to add a new tab, add a new worksheet. And we're going to call this the DCF valuation. And on this tab, we're basically going to replicate the process that McKinsey did for Home Depot that was in the book. Okay? So this is our first step. Can you hit those middle 2 light buttons and push those up while you're standing there? Thanks. We'll see. All right. So to do a discounted cash flow, DCF, enterprise discounted cash flow valuation, what we're really doing, we're going to start out with the operating value, which is the free cash flows drive the operating value. So we need our forecast for free cash flows. So that's what we're going to do first. We have our forecast for free cash flow. And that is off the CFI tab. So our CFI tab, the reason why we did it is because it gives us our forecasted free cash flow, which is row 12 on the CFI tab. The first year of the forecast was 2014. So basically what I want to do here in Excel is I want to have my first forecast year. Now I'm going to pull that off of the ratios tab just because I want it to be a relative reference. So when I change the model, it automatically adjusts the years. But my first forward year for Coke right now is 2014. And then I forecasted 11 years worth of data. Now, as the book talked about in the reading for this week, we actually want to forecast one extra year beyond our defined forecast period for the beginning of the continuing value period. So last week when we did 11 years of forecast, we did it so that we would set up 10 years worth of defined forecast. Year 11 would be the beginning of the continuing value period. Or basically, 2014 to 2023 is our year-by-year forecast. 2024 is the beginning of the continuing value period. Now, we picked 11 years arbitrarily. Ideally, what we want to do is we want to make sure that when we go into continuing value, the company is mature. We also want to make sure that we forecast an entire business cycle. That's why we're picking at least 10 years. So I've chosen arbitrarily 11 years. Now, for your group projects this semester, you're going to be working on publicly traded, fairly big companies. So by going out 11 years, they should meet that criteria, right? But the short answer is I've chosen 11 years arbitrarily. So again, in this case, I want my 10 years of forecast equals previous year plus 1. And I'm also going to go down the rows so that we can print this out on one sheet of paper eventually, okay, rather than going across the columns. All right, so then what I need to do is I need to get the free cash flow for each one of those years forecast. So off the CFI, 2014, CFI, free cash flow, row 12, H12. 2015, off the CFI. I-12. 2016 forecasted free cash flow off the CFI, J12. 2017, K12. 2018, L12. 2019, M. 2020, N. 2021, O. P for 2022, and Q for 2023. So these are the free cash flows. H, I, J, K, L, M, N, O, P, Q for the next 10 years, assuming that our financial statements come true. And again, I'll just get rid of a couple of decimal places just to make it a little bit easier to see. All right? So I next want to take these free cash flows and present value them, right? Because I'm doing the valuation as of today. So that was the process where McKinsey had multiplied it by the discount factor, and the discount factor equals 1 divided by 1 plus r to the power of t or n, depending on number of periods. So the r in our model is the WACC. So 1 divided by 1 plus, off the assumptions tab, the WACC. Now, I want to make this an absolute reference to cell B4 on the assumptions tab, so $sign in front of the B, $sign in front of the 4. So assumptions, $sign B, $sign 4. That will always refer to that WACC cell. Then what I want to do is I want to copy this down, all 10 years, and then I want to make sure that I put it to the appropriate amount of periods. So in the first year, I divide by 1 plus r. In the second year, I divide by 1 plus r squared. So shift 6, 2. Caret 2 is what it's called, squared. Third year to the third power. Caret 3. Fourth year to the fourth power. Fifth year to the fifth power. 6th year to the 6th power, 7th year to the 7th power, 8th year to the 8th power, 9th year to the 9th power, 10th year to the 10th power. Or another way of saying this, 1 plus r to the 10th power, 1 plus r to the 9th power, 1 plus r to the 8th, 7th, 6th, 5th, etc. Right? So that I get my discounted free cash flow, which equals the free cash flow times the discount factors. That would be the present value of each one of those free cash flows. Right? So again, the discount factor is just a way of breaking out the present value into two cells, because present value of a cash flow is the present value divided by 1 plus r to the number of periods to the power of n. What we have is we have the cash flow here, and we're multiplying by the discount factor, which is 1 divided by 1 plus r to the n. Right? So essentially, that's all we're doing here. We're just multiplying b by c to get d. Okay, just breaking out the present value formula into two cells. If you wanted the present value using the Excel function, you can do that as well. You just have to give me the present value of the cash flows. Yes?
Can you just show us the equation is C3, just to see how it's changing? Wow.
So C2 is 1 plus assumptions B4. C3 is 1 plus assumptions B4 squared. 1 plus assumptions B4 cubed, etc. Because this is 1 plus r to the 4th power, basically, just going down. All right, so if I then sum these present value of free cash flows up, then what this gives me is the operating value for the first 10 years. That's our forecast, assuming that our financial statements come true, of the value of Coke for the first 10 years of it selling Coke. Right? But Coke will live beyond 10 years. Bless you. So the idea is when we value a company, unlike when we value a project, we assume companies last forever. So that's called the continuing value period. Right? So what we then need is we need a continuing value, or CV, estimate for Coke for year 11 into perpetuity. Now, when we did the continuing value assumption, this was covered in the lecture notes, but basically this continuing value is, from this week's reading, the key value drivers formula. Right? That was the rearranged growing perpetuity, and these are the 4 drivers of continuing value. Notice one of them was no plat T plus 1. T plus 1 is the year 2024. It's that extra year that we define at the end of our forecast period. That's why you always forecast 1 additional year, which is the beginning of the continuing value period. I need a RONIC, which is our 2024 ROIC. It's the return on invested capital in the continuing value period. I need a G, which is the long-term growth rate. Think growth for 50 years. And then I need a WACC. Those are the 4 things that I need to estimate for my continuing value. Now, because I want to make this a reusable model, I'm going to solve for continuing value here, but on the assumptions tab is where I'm going to list my continuing value assumptions, because they will change company by company. So I will need a continuing value no plat. I will need a continuing value ROIC, also known as RONIC. And I will need a continuing value G. And those are going to be yellow. Now, continuing value no plat equals, off of TII, our 2024 no plat, R4. Continuing value ROIC equals, off of our BOY EP, so make sure you use the BOY tab, 2024 ROIC, Q15. And our continuing value G, 3%. We're going to use 3% as our initial assumption. The reason why we're going to use 3% as our initial assumption is because we're going to say that a company long-term, very long-term, as a starting assumption, should grow at about the rate of the economy. The US and European economies are generally growing at about 3% a year long term. So we're going to assume 3% as our starting G. We can always adjust that later, but that's why we're starting out with 3% as our G. Yes?
What was the CV no plat?
The CV no plat will be our 2024 no plat. So TII R4. And the RONIC, the 2024 ROIC off the BOI tab. Q15 off the BOI tab. Okay. So now what we're ready to do is we're ready to put this continuing value formula into our DCF valuation tab right here into cell B14 with the correct order of operations. So equals left paren, and I'm going to get all the data off my assumptions tab. That's why I put it all in one place. So I'm going to take my CV no plat times left paren 1 minus the CVG divided by the CV ROIC, right paren, divided by left paren, WAC minus CVG, right paren. A little over 121 billion, 121,417.66. And again, I'll get rid of a few decimal places on each of these just so it's easier to see. So that is the formula you're trying to replicate. So what this represents, this formula, is the value of Koch's free cash flows from year 11 into perpetuity. Okay? Now, implied in the growing perpetuity equation, the rearranged one that we're using, is a discount factor. Right? There's a WACC in there. So we're already discounting those cash flows by putting into that formula, except it's going to discount them to the beginning of 2024. Right? Well, I need to bring this back to a present value of today. For all intents and purposes, the beginning of 2024 is the same discount rate as the end of 2023. All right, so I don't want to double discount the year 2024. That's a common mistake people make. So what I'm going to do is I'm going to use the same discount factor as 2023 to bring this back to a present value. So today's value, the continuing value, is that continuing value times that discount factor. So the operating value of Koch is the sum of those two numbers. And what we're estimating is about 111,863,000,000 and change. Right? That is what Koch's operating value, based on its free cash flow forecast, would be if those cash flows came true at that discount rate. Okay? Now next, we want to solve for enterprise value, which means we have to add in the non-operating value of Coca-Cola. Well, this is where TFI helps us, because on our TFI, we had identified the non-operating items on the balance sheet. Okay, so that's what we're going to add to our operating value to get to our enterprise value. So I go back to my valuation and I put in off the TFI the three non-operating asset lines: excess cash, net non-operating long-term assets, and long-term investments and long-term receivables. Okay, those are my three long-term investments. Now, here's the thing. For cash off the TFI, I'm going to use my 2013 actual value. So I'm not going to use the forecast for the non-operating assets. I'm going to use the current value, which is already in a present value. So last reported cash equals TFI 2013 TFI. And I'm going to do the same thing for non-operating assets and long-term investments. So first, let's talk about non-operating assets. I don't know what the non-operating assets are, but I'm going to assume that they're probably worth close to the book value of the company. If ever something wasn't worth the book value, I could always overwrite it. but I'm going to assume it's probably worth the book value of the company that they're being reported at. Because one of the things the accountants do is if non-operating assets lose value, they will write them down. Okay? The tricky part is the long-term investments. Because if I make long-term investments into another business, the market value is not represented. So for example, when Yahoo owned Alibaba before Alibaba went public, Yahoo reported the value of Alibaba at book value, what was originally paid for Alibaba, not their market value, which was significantly higher. So the accountants don't let you put the market value on your balance sheet. They don't let you put the book value in the balance sheet. Now, if the book value loses value, they'll let you write it down, but they won't let you write it up, right? So I know it's kind of a floor for the value, but it's not a ceiling. So here's what we're going to do as an adjustment. On the assumptions, I'm going to put in an assumption called the price to book multiple of long-term investments. And initially I'm going to make it 1. And then on my DCF valuation, I'm going to take my long-term investments and I'm going to multiply it by the assumptions that price to book value. Okay? So let's just say that the market value of the long-term investment that I made into another business is worth 15 times what I paid for it. Well, I go back here to assumptions, I change this to 15, and now on my DCF valuation, I have a more representative market value. Okay? So the price to book multiple is there so that we can adjust the long-term investments to a market price, assuming we knew what the market price was. All right? If we don't know what the market price is, at least on a conservative basis, we'll leave the price to book multiple at 1 and we'll at least value it at book value. Okay? But it's just a way of adjusting the long-term investments to a more reasonable price if we knew, which would mean that Coke, which owns pieces of its bottlers, we'd have to go out and figure out what those pieces of those bottlers are worth if we were really doing Coke. All right? So let's assume it's book value. We then solve for the enterprise value, which is the operating plus the non-operating asset value. So basically I sum these 4 things. That's our forecast for the enterprise value, or EV, of Coke. About 154 billion and change. 154,788.71. Right? Now, continuing on with the Modigliani-Miller model, from enterprise value, that equals our debt and our equity. So to get to an equity valuation, I'd have to pay off all the debt. Right? So I have to subtract all the debt and debt equivalents. And then what I would have to do is subtract all the non-common equity, and what I'd be left with is the common equity value. This again is where TFI helps us out, because on the TFI, we had identified the 3s and the 4s. We had identified all the debt, the retirement-related liabilities, and the interest-bearing debt. We had also identified the non-common equity components. I'm solving for common equity, so I don't want to subtract that. But I would have to pay off the preferred stock, and I would have to pay off the minority interest shareholders. Those 4 people have to be paid off before I can pay the common shareholders. Okay? Well, again, my actual reported values in 2013 are what I owe them today. So equals, again, from TFI, 2013 retirement-related liabilities, 2013 interest-bearing debt, 2013 preferred stock, 2013 minority interest. That would get me a common equity value. What's left after everybody else has been paid, which is my enterprise value minus the sum of those 4 things. Or approximately 115,670,000,000 and change. Right? That is our guesstimate for an equity value. Now to turn this into a share price, I next need to know the shares outstanding. This is where Bloomberg will help us. In Bloomberg, if I go to Coke, the first item up here is called DES for the security description. On the first page of the security description, the DES screen, in the bottom left-hand corner is a current shares outstanding for the company. 4385.9 million. So that is the shares outstanding for Coke. Now, earlier today in a previous class, I took a screenshot of this screen. I saved it, save screen, KO-DES. And I posted that file to Canvas in the KO Valuation folder. So there's the KO-DES file. Okay, so the screenshots that I'm taking that we'll need for our model are already in that folder. It's kind of a roadmap of what screens you're going to need in Bloomberg. Okay, so again, my convention is company ticker symbol dash Bloomberg short code. In this case, DES. Okay, now here's the thing. I don't want to enter this shares outstanding directly into this page because I told you last week, good model hygiene says I want to minimize the place where I enter data to either the assumptions or the ratios tab. So I'm going to go back to assumptions, and I'm going to create another assumption called shares outstanding. Bless you. And the shares outstanding, again, was 4385.9. This cell I'm going to make yellow because it's something I could change in the future. Go back to my DCF valuation, refer to that cell, and then that should give me a forecasted share price equals equity value divided by shares outstanding, $26.37. So if our model were to come true, Coke would be worth $26.37. Now, what we're going to do in a few minutes, but we're not quite ready to do this yet, is Coke today is trading at 43 and change. Right? So obviously the model doesn't fully value Coke. So what we're eventually going to do in the as-is valuation is we're going to come back here, we're going to see that Coke's revenue growth rate is expected to shrink in our model by 2% a year. What if Coke grew at 3% a year? Well, if I change the revenue growth rate to 3%, notice it changes the share price to almost $40 a share, right? This is the power of the model that we're setting up. We can quickly simulate a company's share price because as we change assumptions, as we change ratios, everything flows through the model and we'll update the cash flows, the cash flow valuation, right? So we're not ready to do this yet. We're about 10 or 15 minutes away, but this is where we're heading as a direction of the model. So I'm going to undo this. So we're back to where we started. Okay? So we all have the same model. So what we've done very quickly is we've put together the discounted cash flow valuation of Coke. Right? So now what I want to do is I want to clone this tab to do the second valuation, which again was talked about in the video last week, which is the economic profit valuation. So when McKinsey showed you the Home Depot economic profit valuation, what we talked about that was primarily different was how we calculate operating value, right? Because basically everything else is the same, just the calculation for operating value is different, right? In DCF, we forecast the cash flows and discount them. In economic profit, we forecast the change in values, discount them, and add it to the starting capital. We still get an identical valuation with that different methodology. So what's going to be different is just that operating value calculation. So to save us a little time, we're going to clone the tab rather than recreate the whole tab. So if I right-click over DCF valuation under the tab name, move or copy, create a copy, move it to the end, hit OK. That will clone the tab or worksheet in Excel. right? So I now have a worksheet called DCF Valuation 2. I'm going to rename this tab EP Valuation. All right, so what's different about the EP valuation is instead of forecasting free cash flows, we're forecasting economic profit. Instead of discounting free cash flows, we're discounting the economic profit. So I need my forecast for my economic profit. That is going to come off of our EP BOY tab. Remember, we have two economic profit tabs. For this valuation, I want you to use the BOY tab. And the reason why we're going to use the BOY tab is because we're going to get an identical valuation using the BOY tab to the DCF, right? So that's why we're going to use the BOY. So in this case, if I go to my EP BOY, then what I care about is the forecast period. My first economic profit forecast is 2014, so G23. So for 2014 equals EPBOY G23. 2015 EPBOY H23. 2016 off the BOY tab I23. 2017 J23. 2018 K. 2019 off the BOY tab L. 2020 M. 2021 N. 2022 O. And 2023 P23. All right, G, H, I, J, K, L. Now the reason why we're using BOY is because we're going to get an exact valuation match. If we used EOY, we would be close. All right, that's why I'm going to ask you to do BOY. All right, so we now have, instead of the operating value for the first 10 years, we have the change in operating value for the first 10 years. That's the difference between free cash flow and economic profit, also known as economic value added or EVA. The process says we take that change in value for the first 10 years, add the change in continuing value, add that to our beginning invested capital, and that would get us the operating value of the firm. So our beginning invested capital is off of the TFI, 2013 operating invested capital, including goodwill, G7. So when I sum these three things up, I get the operating value of the firm. Now, one of the things that's going to change is I'm going to get a different continuing value because the formula for continuing value in the continuing value of economic profit is different than the one for the cash flow. Again, that was talked about in this week's reading for the book, which I posted under lecture notes 5 for this week. This was the formula for the key value drivers, right, for continuing value from the reading this week. This is the formula for forecasting economic profit. So it is this formula that we have to put into the continuing value cell. Hardest thing you're going to do is put this formula in with the correct order of operations. Okay? So that's what we're going to do. Yes? I'm adding the change in operating value, the continuing value, which we're about to solve for, and the beginning invested capital. Those three things become the operating value. Now, you don't have to put this in your model, but what I want to show you is that the difference in operating values should be 0. So between my DCF operating value and my economic profit operating value, that difference has to be 0. Which means I know the answer to that cell. I've just back solved for it. Right? Now, the TAs also know that you know how to back solve, so you get no credit for back solve. You have to do this using the formula. Okay? Now, here's the point. What we're going to do is in this cell, we're going to put in this formula. The one new item that's in this formula that wasn't in the key value driver formula is economic profit in the year T plus 1. Or another way of saying this, 2024 economic profit. So I'm going to go back to my assumptions tab, and I'd left row 8 blank intentionally, continuing value, economic profit. That is my 2024. So BOY, economic profit, cell Q23. Now I'm ready to solve. So, putting this formula in, equals, off the assumptions tab, continuing value economic profit divided by the WACC, plus left paren, no plat, continuing value no plat, times left paren, continuing value G divided by continuing value ROIC, right paren, times left paren, RONIC minus WACC, continuing value ROIC minus WACC, right paren, right paren, divided by left paren, WACC times left paren, WACC minus G, right paren, right paren. 95,759.86, discounted 45,185.17. The difference between the two valuations, 0. This is what I mean by exact. We're not off by $1. It's not a rounding number. It's literally exact. By the way, this is part A of your final exam. You will be given a bunch of numbers, and you have to use the formulas to show me you get an exact valuation between the two methodologies. Right? But that's why we're using BOY. If we used EOY, we'd be close. Right? With BOY, you're exact. And that's what we're illustrating here. It's obviously a lot of algebra here, but this is the hardest part of the model you have to build. Okay? So basically, putting in that equation. But once you have done that successfully, and once we basically get identical valuations between the two, we're pretty much done with the valuation model in terms of its core. All right, we've essentially built a professional valuation model that the pros would use. Okay? And here's the interesting thing. We've completed what I would call the science of valuation, right? Which means we've put in the formulas, the academically vetted formulas, into a model that allows us to predict and come up with a solution using the formulas. Now we're going to cross into what I call the art of valuation. Because to be honest with you, as complex as the model we've just built is, this is the easy part. Putting the formulas into an Excel spreadsheet is a cumbersome process. It's a straightforward process, and it's actually relatively easy. We're basically just putting in a cash flow and discounting it. At the end of the day, it's just an NPV. What makes the valuation more real is the art of figuring out what numbers to put into the model. That's the hard part of the valuation. Okay? And what matters is, last night I was watching Last Week Tonight with John Oliver. He'd taken a week off, and he had this great segment where he was mocking the Supreme Court, and he had these dogs representing the Supreme Court justices. So they were talking, but the dogs were talking, and they were just overplaying the video. So here's the point. Any dog can create this valuation model. I don't want you to be a dog, right? And here's what I mean by that, is that what makes your valuation good is the assumptions themselves. And you can quickly manipulate the assumptions to get to a solution. That doesn't make you have a good model. What's going to be very important is articulating the assumptions. How did you come up with the assumption? Is the growth rate of Coke going to be 3% or 5%? Why did you say 3 versus why did you say 5, as opposed to just quickly putting in a 3 or a 5? So for this next part of the valuation, it will be easy to just quickly change numbers and get a solution. But the value of the model comes behind the why. And what's important for your grade, what's important for your group project to me, and what's important for the group project to the senior execs of the real companies you're going to be presenting to, is understanding the why. Why did you use the assumptions that you used to create the valuations? Okay, so I just want to distinguish that as we go to the next stage of the valuation of Coke. So when we do valuations in this class, we will always do 2 valuations. The first is going to be called an as-is valuation, which will be your assignment for today and your assignment for Wednesday. What I mean by an as-is valuation is that right now, Coke is trading at $43.25 a share. What we want to do is we want to put assumptions into our model that basically come very close to that share price, right? That's what we're going to call an as-is valuation. So in our Excel file, we want to have an Excel file that comes within, and the range that I'm going to say is acceptable, $1 of the current share price, plus or minus. Okay? So you have to be exact to the penny, but you got to be pretty close. And I'm going to say $1 is our acceptable range. So $1 plus or minus the current share price. That is called an as-is valuation. Now here's the point. When you do the as-is valuation, you're actually putting in some assumptions. And so what we're really trying to do is back out what assumptions the market must be using in order to come up with the current share price that Coke is actually trading at. Okay? So for example, I was recently doing a class for the private wealth management business of Merrill Lynch. These are people that are ridiculously rich, right? And the part of the class I was teaching was how do you invest in individual stocks? And one of the disclaimers was, somebody's like, all right, well, what's your investment advice? And I didn't actually want to give somebody investment advice because if they lost millions of dollars, I didn't want them sending the hitmen after me. Okay, so here's the point, but this is my honest answer, which is I can't tell you whatever company we were looking at whether or not you should buy or sell until you know what the assumptions are behind that share price. Because today Apple's coming out with Apple Pay, right? And then you can say, gee, Apple Pay sounds great. Apple should go up as a higher share price. But if the professionals have already put in assumptions that give them the higher share price, then now's not the time to buy Apple. So what we have to do is we have to know at their current share price, what assumptions could the pros have been using to come up with that share price? Then, do we agree or disagree with the assumptions? By the way, that becomes our second valuation, our point of view on the assumptions. When we put those in, it'll create our target share price, and that will create the buy, sell, hold. Because if our assumptions and the market assumptions are similar, it's going to be a hold, because we're going to come up with a fairly priced stock. If our assumptions lead to a price that's much higher than the market, it's going to be called a buy. And if our assumptions are worse than the market, it's going to be a sell. Okay? But before we do our assumptions, we have to figure out what the market must be thinking. So, how do we do that? Well, let's start out by talking about what assumptions matter. In the as-is valuation, so I'm now going to save this file, because I don't want to lose everything we've done. I'm going to call this our as-is. What matters is free cash flow. That's what's key to the valuation. What matters to free cash flow is gross cash flow and gross investment. Let's come back to our ratios tab. On our ratios tab, what we have to concern ourselves is what drives gross cash flow, what drives gross investment. gross cash flow is no plat plus depreciation. Well, what really matters to forecasting no plat in our model is the forecast of EBITDA will get us our forecast of operating income. So I'm going to highlight this using a different color, and our forecast of tax rate. That is going to get us our forecast of no plat. Okay? Then I need to know the size of the company, so I need to know the revenue growth rate. So to be honest with you, the 95% that matters to your valuation are these three numbers. These are what the professionals key on. In fact, my TA visited me right before the class, and I said, this year we're forecasting revenue growth, EBITDA, tax rate. And he said, oh, that's what I did in my summer internship with the investment bank I was working on. He said, that sounds very familiar to me. And that's the point. This is exactly what the pros are keying on, those three numbers, because they know that forecast gross cash flow. Now, here's the other part. We need gross investment. This is why we made the assumption we did last week. The balance sheet ratios that we are forecasting here are basically the operating assets and the operating liabilities that determine invested capital. All of those are a percentage of revenue. So here's the point. What we've done is we've tied the operating assets and liabilities to revenue as a percentage. If revenue goes up, the operating assets go up at the same rate. We've created the concept of gross investment. We've created the concept of constant productivity. Because as the company's growing, the assets grow, invested capital, gross investment, is the change in the invested capital that deltas it from the previous year and forecasts gross investment. So by leaving everything as a percentage of revenue, we're essentially forecasting gross investment. Now, if we believe productivity should change, we could go in here and change any one of those numbers. But most professionals assume that the balance sheet productivity stays relatively stable into the future, hence why we made everything as a percentage of revenue. It makes our life easier. So to be honest with you, you can change any number on this ratio tab as part of your valuation. But the three that matter most are the growth rate, the EBITDA margin, and the tax rate. So those are the numbers that we need. So let's start with that. Tax rate. Do I think this is a reasonable tax rate for Coke going forward? Now, this, by the way, is why we do EIC. Because in order to come up with these assumptions, we should be well educated about Coke and its industry. We should have read the IBIS World Report. We should take advantage of VBIC. We should take advantage of Hoover's. We should take advantage of the analyst reports that are out there that are available to us. All right, for purposes of this class, I'm going to short circuit all that and just kind of wing it, right? And I'm going to be the dog putting in the numbers, okay? And you can be the cat if you want, right? But the point is that we eventually should have some basis and rationale for what we're putting in here, which means we really got to know more about the company and the industry. But for purposes today, we're just going to be representative. So first question, do I think this is a good tax rate? We had taken an average of the last 6 years, and then we left that average going forward. I think that that looks reasonable given the historical tax rates. So I'm going to say that that's a reasonable tax rate. Okay? If I didn't, I could always change it. Next, growth in EBITDA. So here's the thing. There is an analyst forecast for growth and EBITDA on the EEO screen called the consensus. The consensus comes from the professionals that follow Coca-Cola for a living. They probably are going to do a better forecast than we are. So here's the thing. Rather than create our own forecast for Coke, we're going to use the consensus. Now, we have to forecast a decade, but the first 2 years are probably the numbers that are going to matter the most. And that's the most heavily forecasted part of the consensus. So rather than create our own forecast for the first 2 years, we're going to use the consensus for revenue and the consensus for EBITDA that the market has actually done for Coca-Cola, which is right here off the annual EEO screen for Coca-Cola. Again, make sure you're using annual, not quarterly data. Okay? So here's what we're going to do in our model. Off the assumptions tab, sales forward year 1, sales forward year 2. EBITDA forward year 1, EBITDA forward year 2. those are the numbers that are going to matter most. So those are the numbers we're going to pick off the consensus. So again, earlier today, I had taken a screenshot of this and I uploaded it to Canvas, KOEEO. Right, the file's there as your roadmap. By the way, the last piece of information that we're going to need is the WACC. We're going to need a current WACC for Coca-Cola. So I'm going to go to the WACC screen. Current WACC of Coke, 6.9%. So change this, 6.9. Now you'll notice that when I change the WACC, the share price in our model also changed. It went up. Why did it go up? Why did the share price in our model go up? Yeah. I'm sorry? Yeah, well, what we basically is if we have a lower discount rate, then the cash flows are going to be worth more. And that's exactly what we're seeing the model is showing us. That if I lower the discount rate, the cash flows are more valuable. We're not discounting them as much. And therefore, the cash flows, when we add them up, higher cash flows give me a higher share price. That's what's mechanically happening every time we change an assumption. Matter of fact, the other thing I'm going to want to do, because we're going to change a bunch of assumptions, is on my ratios tab, I'm going to put the forecasted share price on the ratios tab so I don't have to keep jumping back and forth. And I'm just going to refer to the DCF valuation share price. Okay? So every time I do a what if, right on this page, I'm going to see it change. Matter of fact, I could do the same thing on my assumptions tab. I could also put a forecasted share price right here on my assumptions tab. Equals, again, off the DCF valuation. I could have used the EP valuation because they're the same, but there's the price. So that's the point. I have a WACC of 7%. I can immediately see the what if on the share price. Right? Now, I do want to have the same WACC that Coke is using today in the market, so I'm using the 6.9. Right? So, as I said, I now have to go to the EEO screen, and I have to type in this data. So, EEO, I need sales 1. So this is my first forward year sales, 46,437. Sales 2, 47,862. EBITDA 1, 13,062. EBITDA 2, 13,718. That is the consensus for the next 2 years. Everybody see where I got those numbers from? Any questions about that? So forward year 1, forward year 2. Okay? All right. Now, what I want is I want my model's growth rate to match so that I get those numbers in my model. So what I'm no longer going to do is I'm no longer going to make these cells yellow. I'm going to switch them back to white. Because I'm no longer going to be forecasting the growth rates directly. I'm going to solve for the growth rates that get me the earnings estimate sales. So I know the formula for revenue growth is current year minus previous year divided by previous year. So here's what I'm going to do. Equals current year for 2014 would be the fiscal year 1 sales minus previous year off the income tab 2013 revenue divided by 2013 revenue, negative 0.9%. So basically, if I grow at negative 0.9%, then my model now has 46,437 of revenue, which matches the 46,437 of the consensus. Right? I'm going to do this for 2015. So for 2015, equals, left paren, sales FY2 minus sales FY1, right paren, divided by sales FY1. So the consensus is the Cokes can then grow 3.1% next year. Well, again, if they grow 3.1% next year, the model now has 47,862, which matches the 47,862. So all I've done is I've used the revenue growth rate to basically back in to the sales that are in the consensus, which are now in my model. Right? And that's a practice, since we're doing publicly traded firms this semester, that we're going to continue to do, because I want you to use the consensus for the publicly traded firms for the first 2 years. Right? The years 3 through 10, we got to come up with our own. But the first 2, I want you to at least use the consensus for. The same is true for the EBITDA margin. So again, I no longer want us to forecast the EBITDA margin directly, because the market has given us an EBITDA margin. EBITDA year 1 divided by sales year 1 is the EBITDA margin. It's right there in front of us, the raw data to calculate it. So that's what I'm going to do in my ratios. So my ratios equals, off the assumptions, EBITDA FY1 divided by sales FY1. 2015 equals EBITDA FY2 divided by sales FY2. That is the consensus the market has for the EBITDA margin for Coke for the next 2 years. So that's what I'm saying. We're using the growth rate. We're using the EBITDA margin from the consensus. And oh, by the way, when we do that, we now have a share price of $48.77. Much closer to the current share price of Coke, which is 43 and change. All right. Now this morning, just so we're all consistent amongst the classes, the very first class of the day, when I did the first screenshot, Coke's share price was $43.41. Okay, so for your homework 5, what you need to do is you need to now manipulate the rest of the assumptions to get within $1 of 43.41. Okay, so this is what I mean by the as is. All right, we put in everything. We put in the historical WACC. We put in the shares outstanding. We put in the forecast for revenue and margins for the first 2 years. Now, using years 3 going forward, we have to make some adjustments to get to the current share price. That's called the as-is valuation. Now, one of the things that we need to do is we need to articulate the assumptions. Because ultimately, when we grade you this semester, I can't grade you, and the TAs can't grade you on whether or not you're right or wrong, because it's the future, and nobody really knows. So the way that we're going to grade you is whether or not you give a reason that sounds rational for your assumption and is ultimately backed up by something. And then we're going to look at how reasonable that sounds to your assumption as to whether or not we think you're doing the process right. This is why I call it the art of valuation. And it is so important to articulate the rationale for the assumptions when you give your valuation. And like I said, this is what will separate you from a dog. Okay? Because anybody can be trained to just manipulate numbers to come up with a $43.41 share price. You can do that. You can do it easily, but that doesn't make it valuable. What makes it valuable is what did you do and why did you do it? Okay? That's what you're going to have to articulate, particularly in Wednesday's in-class assignment. So when you do this on Wednesday, in addition to coming up with a valuation of the company that I give you, let's say it's Pepsi, even though it's not, then you're going to have to say, why did I come up with the growth rate for Pepsi? Why did I come up with the margin for Pepsi? What's my basis and my rationale? That's what you're going to be graded on, in addition to having numbers that work out correctly. So back to this. So one of the things I notice immediately about Coke is that the market must think, and again, if I'm focusing on 3 variables, that either the revenue growth rate is going to be lower or the margins are going to be lower because I have to get a lower share price. Okay? So let's look at the revenue growth rate. Personally, if I look at the last 5 years, now this is why I would have had to do an EIC. Because if I did the EIC, I would have read the industry reports, I would have had a better sense of what's happening to industry growth, and that could have helped me with the future revenue growth. But for purposes of today, don't have time to do it, so I'm skipping that step. All right? I'm just going to wing it by looking at these numbers. So here's what I do know about Coke. Coke did a big acquisition in 2011 where they bought one of their bottlers. So that growth was not organic, right? And if I look at the last 2 years, the next 2 years, 3% doesn't seem unreasonable to me. As a matter of fact, I think Coke could easily grow at the rate of the economies going forward because even as people turn away from sugary drinks, I think Coke is nimble enough that they could start selling non-sugary drinks. Okay? For example, they already have Dasani. Okay? They already have juices. All right, so if the next thing is vitamin water, they can do their own vitamin water brand. I think Coke will adapt to the marketplace, so they're not just going to give up all their market share just because the market is going away from traditional soda. So that's the point. I think 3% is a reasonable growth rate for Coke. So I don't think the market's viewing them as having a lower share price because they're not going to grow. I think they're expecting more competition and therefore lower margins. So I'm going to actually start adjusting their EBITDA margin down. Now, the next 2 years, Coke's margins are actually expected to go up, partly because they've announced some cost cuts, right? So they're actually announced $1 billion worth of cost cuts, which the market is giving them credit for by giving them higher EBITDA margins. But if you look at the current share price, at that margin, their share price would be higher. So I think the market must think the market's going to get more competitive. So I'm going to start lowering their EBITDA margin. Well, if I look at 2011, 2012, it was far lower than it was today. So I'm going to start ratcheting it down. So 2016, 28. 2017, 27.5. 2018, 26. I'm already within 40 cents of the 43.41 share price by getting to this level of margin. Question?
Why are you expecting more competition?
Good question. So why am I expecting more competition? Give you an example. Walk into any Whole Foods today and try and buy a Coca-Cola product. And the answer is it's actually hard to find Coke products in Whole Foods because they're bringing in all the natural stuff, all the organic stuff. And I think that's the direction we're heading in the world today. That's why you're seeing poor McDonald's, who again, I think in the Last Week Tonight segment last night, they did a good job making fun of McDonald's new advertising campaign, which was a very strange commercial, by the way. Has anybody seen it? They started about a week ago. Basically, they have a talking billboard where you walk up to it and you can ask questions about McDonald's. And they're basically like, what's the chicken really made of? Do you use pink slime in your beef? And this is actually McDonald's coming up with their own questions because people are very worried about the health of the food that they're eating. And that's one of the reasons why they're switching to people like Chipotle. That's why Chipotle is doing good and McDonald's isn't. Because McDonald's has crossed the chasm where people now view it as the quality of Taco Bell, right? And Taco Bell, despite their cute campaigns, is horrible for you, right? And that's the thing. People are starting to be worried about this. So McDonald's is trying to defend themselves, asking the questions that you're asking to say that, no, we're really healthy. I think Coke is going through the same thing. I think people are worried about sugar. I think people are also worried about the dietary supplements in Diet Coke. And are they really actually better for you? So I just think that what's happening is we're moving towards healthier stuff. We're moving towards water. We're moving towards vitamin water. To some degree at the other end, you're moving towards less sugary drinks. Matter of fact, the innovation for Coke and Pepsi is to bring back cane sugar as opposed to corn syrup because people think that's better for you. And I think it's opening the door to competition. People are now willing to try different stuff. So I think that Coke is going to have to fight fire with fire and either spend more money on development or cut their price to keep up with some of these new entries that the grocery stores are letting in. That's my interpretation of the assumption. Yours could be different, right? You could say Coke maintains their margin, their growth is a lot lower, and come up with a share price. But we have to come up with a reason for the lower share price. I'm saying it's a margin contraction. Now, note, they're still making a 26% EBITDA in my forecast. It's not like their margins go to 10%. Okay, it's a slight decline in margin of about 1.5 points below where they used to be. Okay, but here's what I've essentially started to discover is for Coke, let's say I think that the growth rate also slows a little, and I call it 2.9. And oh, by the way, in my continuing value assumption, I probably shouldn't have a continuing value G higher than my 10th year G. So I'll call that 2.9 as well. Well, now I'm at 4269. So what I could say is instead of 26, 26.5. So maybe the margin doesn't fall as much because I get a little bit less growth rate. Here's what I now know by doing this as is. I can't tell you exactly what the growth rate of Coke is going to be. I can't tell you exactly what the margins are going to be, but I have a reasonable range that says low single-digit growth and mid-20s, higher end of mid-20s margin is probably the range the market's thinking about when they're thinking about Coke stock. Okay? So that's the as is. That's what's justifying the current share price of Coke. All right? Now that's different than the final. When we do the final valuation, we put in our own assumptions. Okay? We can change it to whatever we want, and then we'll get a delta for the buy, sell, hold. But for the as is, we're trying to back out what the market thinks. Questions about what I just did? If you've done what I just did, you've completed homework 5. Homework 5 is an as-is valuation of Coke within $1 of 43.41. If you've individually completed that Excel file, you can save it, you can upload it right now. You've completed homework 5. Yes?
Do you need to,
One.
do you need to write the explanation?
For homework 5, no. For your Bloomberg lab assignment on Wednesday, yes. Sorry, your question? Same one? All right, so here's what's going to be different about Wednesday. Okay, so you've basically built out the valuation model. So on Wednesday, when you come to class, I'm going to give you another company. It won't be Pepsi. I'm using Pepsi as a placeholder. It'll be somebody else. And then what you're going to have to do is using this model that you just finished, come up with an as-is valuation of Pepsi. So what does that mean? That means I go to Bloomberg. I look up the company I'm given. Let's say it was Pepsi. I then go to the FA section, and just like we got the income statement, balance sheet, and cash flow data for Coke, we get the income statement, balance sheet, cash flow data for the company that I assign you on Wednesday. Output Excel. Okay? That'll give us the same 3 Excel files we did last week. In addition, and this is where these screenshots will help you, you're also going to have to update the weighted average cost of capital, WACC. Put in the WACC of the company that I give you. You're also going to have to update the shares outstanding, DES. There's the shares outstanding. You're also going to have to update the EEO, the forecasted sales and EBITDA margin of the company for the first 2 years. So basically, you'll go to Bloomberg, you'll get the raw data, you'll put it into the model. You put in the income statement, literally overwrite it cell for cell, the balance sheet, the cash flow. You go to the assumptions. You update the WACC, you update the shares outstanding, and this data. Right? Then you'll manipulate the ratios to get within $1 of that share price. One word of caution. When I reuse this model, things that are in yellow, so think EBITDA margin, are now hard-coded in there. Because that number is now hard-coded 26.5. And let's say the margin of the company I give you is 15. Okay? Historically, it's 15. Well, your 28, 27, and 26.5 are still going to be in there. So you're going to get a crazy valuation for the company because you're reusing data. Remember that because you may have to update that data as well so you don't have lingering hard-coded numbers that go in to another model. That's why it's so important to limit the areas of changes to these 2 spreadsheets, these 2 worksheets, because that's what we're going to then continually update for the company. So on Wednesday, I'll give you a company at the beginning of class. During class, you'll basically have to get the data, put in the model, come up with an as-is, and unlike today, you'll also have to turn in a write-up explaining why you changed the assumptions. Okay? That is going to be Wednesday's in-class assignment. Questions? And then depending on whether I get the list of companies, either Wednesday or Monday, you'll also select your teams. okay, for your group projects. And then very quickly, you'll use this model for the group project, and we will continue enhancing this model and practicing using this model continuously over the next few weeks. Okay, so we're going to be doing a lot more Excel work. Questions about anything? All right, this video is going to be posted in just a few minutes on YouTube. Otherwise, again, if you're finished with what we did today, you're welcome to upload. You've completed homework 5. If not, you'll have until Wednesday, 10 a.m. Good luck.